Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing language of corporate filings to tell you what is really going on. Today we're diving into Windtree Therapeutics Incorporated's latest report, and let's just say it involves some interesting financial maneuvering that might make you scratch your head. So grab your coffee because we're about to break it all down. If you're new here and love getting clear, no-nonsense insights from EC documents, make sure you're subscribed, and don't forget to join our growing community on Discord. The link is in the description below this video. So, on the 9th of October, Windtree Therapeutics, Incorporated or Wint as they retraded, dropped a report detailing some significant financial actions. The main story here is the issuance of new debt, specifically senior convertible promissory notes, totaling $1.6 million. Think of these as loans that can eventually turn into ownership shares of the company. This is happening in connection with settling some agreements related to real estate and development services. It sounds complicated, and it is, but the core issue is they re-raising funds and dealing with existing obligations. Now, this new bunch of notes, they call them commitment notes, are positioned as junior to another note from June of 2025. This means if the company has to pay its debts, the older note from DFU Incorporated gets paid first. This is important because it tells us about the company's capital structure and how risky these new notes are. The company is saying basically these new loans are secondary, meaning there is more risk for the holders of these commitment notes compared to the holders of the older note. Here is where it gets particularly interesting. These notes have a maturity date of the 9th of October 2026, and they LL charge 10% interest annually. But the real kicker is how they can be paid back. A significant portion, 25% of any money the company gets from selling common stock, has to go towards paying back these notes. And get this, there is a 120% prepayment penalty on that. That is a hefty price to pay if they decide to repay early using that specific source of funds. So it is a bit of a double-edged sword for the company if they get incoming cash from stock sales. The report also talks about what happens if Windtree Therapeutics Incorporated raises over $1 million through a qualified equity financing. And when we say qualified, we mean new money, not just converting these existing notes or other debt into stock. If that happens before October 2026, they have to pay back these commitment notes in full. And again, there is that hefty 120% prepayment premium. This repayment would be due within 1 business day of closing that financing. The company has to give the note holders at least 10 days notice before this financing happens, and during that time, the note holders have the option to convert their notes into stock. This essentially forces the company hand if they want to raise significant capital through new stock sales and want to get rid of this debt quickly. But it comes at a steep cost. Then we have the ownership limits. The holders of these notes can own more than 4.99% of the company stock after converting their notes. This is a common way for companies to prevent any single investor from gaining too much control too quickly through debt conversion. This limit can even be increased to 9.99% with 61 days. Notice, this is a move to appease potential large investors who might want more flexibility, but also to prevent them from becoming a dominant force overnight. The conversion price itself is also pretty dynamic. The note holders can convert their debt into shares of Windtree Therapeutics, Incorporated stock at a price that is 90% of the lowest stock price over the 20 trading days before they convert. This is often called a discount conversion. What this means is that if the stock price goes down, the conversion price also goes down, making it more attractive for the note holders to convert. It is a way to incentivize them to take on the risk of holding this debt, knowing they can potentially convert into stock at a favorable price. There is also a mention of $1,500 for each conversion related to review and applicable deposit. This sounds like it could be a fee or a processing charge associated with the conversion process. It's a small detail, but it adds to the complexity and cost of these financial instruments. Like most debt agreements, these commitment notes have what are called events of default. This includes things like not paying on time, breaking other promises in the agreement, going bankrupt, or if the company's control changes hands. If any of these happen, the entire loan can become due immediately, and the company would owe not only the principal and interest, but also an extra 120% of the unpaid principal. This is a significant penalty and a strong incentive for the company to stay on good terms with its lenders and avoid these default triggers. A crucial requirement is that Windtree Therapeutics Incorporated must file a registration statement within 20 days of the 9th of October. This is so the note holders can legally resell the shares they might receive upon converting these notes. This signals the company's intention to make these shares readily tradable by investors in the public market. Now, let's talk about dilution. If the company, while these notes are still active, issues new stock or similar instruments at a price lower than the current conversion price, that is considered a dilutive issuance. In such cases, the conversion price for these notes automatically drops to that lower price. This protects the note holders from seeing their potential ownership stake get devalued by the company issuing stock too cheaply later on. They must notify the note holders the very next day after any such dilutive issuance. What happens if there is a fundamental transaction? This usually means a merger, acquisition, or significant sale of the company's assets. If such an event occurs while these notes are outstanding, the note holders have the right to receive the same deal that other shareholders would get. Essentially, their debt converts into whatever the acquiring company is offering for the company's stock. This is a standard protective clause to ensure the note holders aren't left out in the cold if the company gets bought. There is also a mechanism where if the conversion price becomes significantly lower than the market price, specifically if it is less than 80% of the lowest sale price over a 20-day period on certain specific dates, the conversion price automatically adjusts downwards. This is another layer of protection for the note holders, ensuring their conversion option remains valuable, even as market conditions fluctuate. And finally, a really interesting option for these note holders. If the company does any kind of public offering or private placement of new securities, the note holders can choose to use their outstanding debt, both the principal and any accrued interest, as payment for buying into that new offering. They can essentially roll over their debt into new equity or other securities being sold by the company. The conversion price for these rollovers will be 80% of the price paid by other investors in that new transaction, which is a pretty sweet deal for them. The report also confirms that these notes were sold without being registered with the SEC, relying on exemptions for private placements. This means they can't be easily offered or sold to the general public in the US without meeting registration requirements. This is standard practice, but good to note for transparency. And just to wrap up the formalities here, they V-filed the details of these notes as an exhibit. It is important for investors to see the full legal document behind these transactions. Now, let's talk about what all of this means for Windtree Therapeutics Incorporated. This whole issuance of convertible notes is a sign that the company needs capital, and it is willing to pay a premium and offer favorable conversion terms to get it. The 120% prepayment premium is a big red flag, indicating the potentially high cost of freeing itself from this debt if it secures future funding. The dynamic conversion price and rollover rights are designed to make these notes attractive to investors, sharing some of the downside risk with the company. If the stock price falters, the beneficial ownership limitations are standard, aiming to manage potential shareholder voting power. However, the need for debt with such attractive conversion terms suggests that the company might be facing financial challenges or sees significant growth opportunities that require immediate funding. The complexity of the repayment clauses, especially the penalty for prepayment from stock sales or equity financing, points to a challenging balancing act for the company's management. They need cash, but they also need to manage the cost of acquiring that cash very carefully. Looking at the overall picture, Windtree Therapeutics Incorporated is navigating a difficult financial landscape. The reliance on convertible debt, while a common tool, can lead to significant dilution for existing shareholders if not managed strategically. The 10% interest rate is also quite high, adding to the financial burden. The company's path forward likely depends on its ability to either achieve significant growth that justifies this debt, or to secure more stable, less punitive forms of financing in the future, or even generate free cash flow to pay down this debt. The risk for investors is that if the company does perform as expected, the dilution from converting these notes could significantly reduce the value of their existing shares. The major opportunity here is that if Windtree Therapeutics Incorporated has a breakthrough, these convertible notes could be converted into stock at a discount, acting as a powerful engine for growth for the company and a lucrative exit for these particular investors. The major risk is the high cost of this capital and the potential for significant dilution if the company's stock performance does outpace the conversion terms. So, what is my take? Windtree Therapeutics Incorporated is in a phase where it is certainly taking on significant financial obligations to fuel its operations or growth. The terms of the commitment notes are aggressive, suggesting that securing this capital was easy. Investors in these notes are betting on future success with built in protections and potential upside. For existing shareholders, this report signals potential dilution and a need for the company to execute exceptionally well to overcome the costs associated with this financing. It is a high-stakes game for Windtree Therapeutics, Incorporated. Alright, that is our breakdown of Windtree Therapeutics, Incorporated's latest filing. What is your take on these numbers and what they signal for the company? Future, do you think this type of financing is a smart move when a company is in their position? Drop your thoughts in the comments below. If this analysis was valuable to you, hitting that like button really helps us out. And don't forget to subscribe for more straightforward insights into the world of corporate finance. And hey, join the conversation and connect with other finance enthusiasts by checking out our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next video.